The Property Show is offered to you by Thomas Oliver. Outstanding financial services. No confusions, just solutions.
The Property Show is produced by Oliver and presented by Karl Knipe, partner at the Kings Group Estate Agency.
Welcome to the Property Show. I'm Karl Knipe and I'm delighted to be with you all. Really excited and looking forward to presenting these programs over the coming months. Got various guests with me who I'll come on to today. Lovely to have you listening in. Hopefully you'll enjoy the show and we'll answer some of, or help answer some of your questions that you might have about the property market, what's happening out there at the moment, and we're going to discuss all these sort of things as we go on. So, Karl Knipe, well, I'm a bit like you. I was born not in this area. I was born up in Sheffield in Yorkshire, but I moved here looking for a better life, wanted to better myself. Came down here when I was 19 and started off working in the estate agency industry. At 24, I set up my own estate agency business, Kings Group, with my partner to this day, Thomas Payne. And we've now got 15 offices throughout East London, North London, Essex and Herts. So hopefully with over 30 years experience, that'll be useful to put that out there to you to maybe try and talk about lots of topics that we're going to come up with. Today I've got with me Chris Bramham from Metropolis Surveyors.
Hello, Carl.
Hello, Chris. How are you?
I'm very well, thank you.
Lovely to have you with us.
Thank you for having me on and inviting me on the show.
It's a pleasure. I've got Royden Weeks, who's the sales director from Kings Group. Royden.
Good afternoon, Carl.
Good afternoon to you. Lovely to have you with us as well. Thanks for making the time.
It's a pleasure to be here.
Great. And Vijal from Thomas Oliver.
Hello, Carl.
Oh, yeah. And Vijal, what's your sort of specialty there?
Financial advice, so mortgages and protection, investments and pension, that's what we focus on in Thomas Oliver. Basically giving our clients the best service we can.
That's great. Well, that's certainly a massive part of the property business. If you haven't got the finance, you can't buy. And one of the things that we'll come on to is obviously the difficulties of mortgage finance and various other issues these days.
Good luck.
Right, so let's get straight on and let's talk about, I suppose, the thing that most of you listeners are out there are interested in. What is actually happening with the property market? Is it a good time to buy? Should we be selling? Should we be worried? Is there alternatives? Royden, how do you see things at the moment?
It's a tough one. When you say is it a good time to buy, there's good reasons to buy at the moment, and there's not so good reasons to buy at the moment. So I can never really answer that question with a straight answer. I think the thing that is probably holding a lot of people back at the moment is there's just so much indecision since the Brexit vote. So a lot of people, the uncertainty means that they're just holding back a little bit, and it then gives a bit of a backlog, I think, to what happens in the rest of the marketplace.
But if people are not buying property, then Vijal, what other things could they look at?
So the first thing they look at is investments, I would say, but also I think it is a good time to buy. It depends on your who you actually are. If you're a first-time buyer, it is the best time to buy.
Why is that then?
Because we've got stamp duty cuts. If you're buying under 500,000, the first 300,000 is stamp duty free. That's a saving of £5,000 straight away.
You tease, but it seems to me that the biggest question that everyone comes up with as first-time buyers is they need a very big deposit these days.
Well, that's where we're seeing a lot more families help out. We're seeing a lot of elder statesmen basically release money out of their properties and give it to their children.
So how does that work then?
So a lot of elder people have a lot of properties in their portfolio, in the excess of 3 or 4. And there's a lot of equity in those properties because usually they've had them for about 10 or 20 years. So we're starting to see that the actual equity they have in those properties are well over 50%. We can release that money for a normal mortgage and we can gift that to their children to help them get on the ladder.
Is that what they should be looking at though, a normal mortgage, or should they be thinking about maybe selling and downsizing, or we hear a lot about these equity release mortgages?
It depends on the age, first of all. So if they're very elderly, yes, then we have to go through the equity release on their residential. But I'm not talking about raising money off their residential property. I'm talking about raising it off their investments, which you're able to do in later life as well.
When you say investments, what do you mean by that?
So basically mortgages that you rent out to tenants.
Right, so if people have got buy-to-let properties,
yes,
they don't need to have to sell that and go through the cost of that. What they could do is maybe look at refinancing, is that the word?
Yeah, so refinancing, not only to give to their children, but also due to these new tax changes. This is a big factor. People need to be seeking financial advice to understand their tax position.
All right, let's hold that tax. We'll come back to that. How are you seeing the market out there?
I think it's quite interesting what we're seeing, and this is, we're a national business, so we see it across the whole of the UK, and what we have definitely seen is a slight cooling in London and the South East, and whether you call that Brexit or readjustment or anything else, that the London market has really got overheated. But if you look at areas in the north, the northeast, the northwest, areas around Manchester, what we're seeing is a lot more activity, particularly where buy-to-let landlords are starting to buy property in the north, because obviously they're getting better yields up there, the properties are cheaper, there's lots of student accommodation that is in high demand. So what we're seeing is nationally the picture is a lot better than some of the pockets that we see in London. And I think that what we have to do is, as a national business, we can't just focus on one particular area. But there's definitely, ebbs and troughs in the market.
So are you saying, in your opinion, you think people should maybe consider, rather than buying locally, that it's just something certainly in the Greek community they've always tended to keep it tight and close where they can literally drive there, touch it and feel it? Are you saying that maybe you should consider a little bit further out?
Absolutely, and I think, and obviously this is based on what we see and what we understand being in this industry, is that if you look at areas in the northeast, areas like Sheffield, Leeds, where you've got high student...
that's a long way away, Chris.
It certainly is.
I was thinking more like Harlow, that's far out harvesting.
I think the important thing is that what you have to look at is that yield, and if you are investing in property, you've got to look at yield. And that's really what's important. And what we're seeing is that because the London market has got very overheated both in price and demand, people are starting to look a bit further. And you're right, it probably might not be central London, but it might be Harlow, it might be Hertfordshire. But certainly what we're seeing is that demand is increasing in areas outside of London.
What's your thoughts on that? Have you got any good areas that you think that... Chris talks about yield, but I think, again, that from my experience of dealing with investors over the last 30 years, yield's very important because that's what sort of is the initial profit up front, but it's also a long-term gain. I.e., if we look at areas of East London, they've gone up certainly more than some of these areas that Chris is saying, but or is it a case, maybe they're going to catch up? I don't know.
I think there's a lot of mileage in what Chris says, that, the areas outside of London where you probably get better value for free money, in my opinion, if you look at it from that point of view, it's still good to buy there. A lot of our offices over there are doing some good figures at this moment in time. So I'd say the issues that we're probably seeing is that where the London market has become, perhaps a bit pricier than most. The yields don't necessarily work out, and maybe the mentality of the sort of inner city sort of owners is still stuck in a couple of years ago when prices were flying through the roof and you could get whatever for your property, and they need to kind of a bit more of a realisation that we're in a marketplace where you've got to do a lot more to your property, or you've got to kind of price it correctly to get the right buyer and sell. So
are we saying that prices in sort of inside the M25 in North East London, we're saying they're flat, they're falling, they're rising?
Again, there's no hard and fast exact,
But you're saying there's differences in areas?
Different pockets, different areas. I think, I witnessed in one of my offices, a couple of days back, we had two similar properties, but they're probably like a mile apart, and it seems that the pricing was trying to be similar for both, whereas one area was more desirable, so you could see that one would sell probably quicker than the one that was the same size, but an area probably less.
But hasn't that always been? There's always been areas, particularly, we hear about all the time people trying to say that they're living in certain areas to get their kids into school. So there's always been that demand, just another road, just another house in some issues, or areas rather. But are we saying overall that we think prices are going to go up this year then, or? What's your call on that?
I think there'll be a small increase in property prices, if I'm honest. I think the market will be fairly flat and there'll be little dips, through the sort of, the traditional, busier months. But on the whole, it's going to be a very, very small increase. I don't see anything.
So just putting you on the spot, Chris, then, do you agree with that? And what percentage are you going to call the market?
I would agree. I think we're looking at single-digit increases. And if you look at all the stats...
So still increases,
yeah, I still think we'll see an increase in London prices and national. But I think what we've got to be mindful of, we won't be seeing these double-digit increases that we've been used to getting. I think the important thing is, and this is where we are seeing a little bit of a correction, is around new build properties, and in particular where there's been wholesale development of things like flats. In the past, what has happened is that new build flats have often sold off plan. But there are parts of London, areas that, for argument's sake, maybe southeast London, there are developments there where there's a lot of unsold, newly finished properties. And I think that's where we're starting to see a little bit of a correction. I think also, and I'm very mindful, but what we are seeing is that with the Help to Buy deposit schemes over the last few years, what we are seeing is quite a high premium being built into new build.
I was going to ask that. That was one of the things I was going to say. I mean, how does that affect mortgages, Vijay? I mean, how attainable are they on these new builds? I know that there's government support there, but how attainable are they?
I would say recently we've seen a lot less price differential between new builds and older properties. Sort of when I first came into...
Agree with that, Chris?
I think what we're seeing is a definite correction in the new build prices
coming down. Really?
And that's because there's so many unsold units, and what's happened is we've been used to seeing them sold off plan before they're even built. But now in places around London, there's several of these developments where they aren't selling as quickly.
Okay, so what are you saying then? Really, then the government's fueled property prices in the new build market. Would that be in your opinions?
I think if you look at it in the cold light of day, if you take Help to Buy for argument's sake, Help to Buy, the deposit scheme in London was up to 40%. And we already know, history tells us that new build properties, like new cars, carries a premium. Mm-hmm. The minute that becomes a second-hand property, you will see a readjustment in that price. If you build into that a 40% deposit that the government have been, releasing, it does mean that those properties could potentially be overpriced. Now, the benefit of that is that there will be properties that are going a lot cheaper than they were as new build properties. But the danger is, in some areas, we might see some bits of negative equity because of the combination of the Help to Buy and the new build premium. So we have to be very, very careful. And as a business, it's our job to go out and value these properties. So we have to be very mindful of that when we're taking that.
Just talking about, I'm not thinking so much about first-time buyers now, because I can see the compelling view for first-time buyers. If the government's helping them and pushing them down that route, and they're giving them the deposit or helping them get on that ladder, I can see why that's swaying them that way. But from an investor's perspective, I mean, are you saying, because the investors have always been really interested in these lovely new builds, they're there, there's nothing they can do, they can just put tenants in there in a way. Are you saying that really they should be very cautious? Vijay, what's your thoughts?
Yeah, so I've always said that new builds are like new cars. They lose value as soon as you buy them. So the only factor was that 2 years ago, the market was so strong. We were seeing double-digit increases. Yep. So you weren't realising that loss because the market was picking it up so quick. We're in a stable market now. Times are different. That's why the new build prices have adjusted slightly, and they're more like older build prices. But I would still be wary of them. I really would.
So, sorry to say, are you sort of saying it's a bit like one of those old cartoons where the coyote runs over the top of the cliff? The cliff's not following him there. It's just going to be a big drop.
It could be. It could be. I'm not going to stick my neck out.
I don't think it'll be a huge drop. Yeah, there's a potential for a drop.
I would agree.
Is it a drop or is it just a readjustment?
It's a readjustment. And I think the important thing to bear in mind is that as whether you're an investor or whether you're a buyer, now is the time to be very canny about trying to drive the price, because if you look at developers that are sat on developments with lots of unsold units, everything has a price.
I was going to say, so surely that if you've got I won't say a wad of money, but you've got to put some money to put down, and you don't really know which way to go. Surely now's a great time to have that. Cash is king, isn't it?
Absolutely, and I think if you buy a 3-month-old demonstrator car, you're getting a better deal than you are on a brand new car. Right. Because it's only done 2,000 miles, but it's had the hit of the initial price premium. So when you're looking at these properties that are new build, that have been used to being sold off plan, but are now actually not being sold, now's the time to go in and negotiate the price. Now, that might not happen on every single development, because developers will always hang out for the best price. But realistically, no developer wants to sit on stock unsold. So I think it is a time to look at things like new build, but be very, very mindful of the price that you're paying for it.
Is there not such as good deals roiding around with people who need to move for various other reasons? Be that I heard myself this week of a couple of situations where people have got to pay the tax bill and they haven't budgeted for it. They've not factored it in, and there's a little knock at the door from the Inland Revenue. They want their money.
They put the property on the market.
Yeah.
I think that you can get. I hasten to say deals, because the marketplace is about getting the right price property. So you can I certainly advocate getting second-hand properties. There's you should be purchasing. There's good value in buying a second time home that was a new build, or it's just someone's property that's ideal for you. It just, I think something else needs to happen in the marketplace to give people that push of confidence to go out and do that. I
think there's another issue that could potentially benefit people that are looking to buy second-hand properties, and that is we are seeing more and more people on interest-only mortgages that are coming to end of term that are not getting a suitable replacement for that mortgage.
What you mean? They're not being given another interest-only mortgage?
So they're having to sell their properties.
Well, why is that, Vijay? Sorry, just why? Surely, if you've already got something, they can't take it away from you.
It's regulation these days. So the difference between mortgages 10 years ago and today is the fact that they're regulated. Because let's be honest, 10 years ago they weren't regulated. You could do what you want. Now it's all about affordability. When you're buying your residential property, it's your income and expenses, and we assess your affordability to see how much of a mortgage we can get you. That is it. There's nothing else.
So is there anything such as an interest-only mortgage anymore?
Only on... There's a couple of scenarios. So on buy-to-let mortgages, they're still common because it's more about the rent covering the mortgage.
I think maybe we should probably just explain what an interest-only mortgage is compared to repayment mortgage.
Yeah, so an interest-only is basically you're paying the interest, and at the end of the term, you still have that outstanding capital to pay back to the bank.
So if you borrow 100,000, 25 years down the line, or however long the term is, you still owe 100,000.
Exactly. Whereas capital repayment means that you owe nothing at the end of the term. So residential mortgages are now usually done on capital repayment unless you're a high earner or have severe assets in the background that you can prove can repay back that loan.
Okay.
That's residential mortgages, buy-in to live in.
So when a client comes to you and sort of says, well, I'm thinking of moving, or I'm interested in buying a property to buy to, do you discuss these options with them?
Yeah, so it's basically, first of all, we look at, is it a residential, is it a buy-to-let? After that, if it's a residential, our interest-only options are limited, like I said, unless you're a high earner or have severe assets. But let's say you're doing a buy-to-let, then we do discuss whether you want repayment or interest only. Because
is it a case of what you want, though? Is it what you're given? I don't know.
It's still what you want, because lenders will still...
I'd want a mortgage where I don't pay any interest or anything, so that's what I'm saying. I mean, how realistic is that?
You can get a repayment or interest only on a buy-to-let. On a buy-to-let mortgage, interest only is still the most common way, because you want your yields on the rent.
It's about the rental cover, isn't it? You can't... most buy-to-let mortgages don't really stack up on rental coverage, so it is why interest only is the common one.
That's one of the questions I was going to ask. I mean, correct me if I'm wrong, from my understanding is that the lenders have become much more avaricious in terms of working out what the rental is coming in relation to what they lend on that. Is that correct?
Yeah, so the stress rates are a lot higher. So the rent...
higher than when? What, a year ago, 2 years ago, 5 years ago?
About a year ago.
It came in
that
September with the PRA changes, because what the PRA, the Prudential Regulation Authority, say is very simple. That if you're a buy-to-let investor and you've got 5 properties, then you have to make sure that the rental covers all the properties, so that if one property loses a tenant, you don't get rental, that it's stretched sufficiently that you can still afford the mortgages.
So if you've only got 1 or 2, then there's not as many checks and questions as if you've got 5, 6, 7, 8, 9, 10.
Well, I think you're probably better to answer that, Michelle. But
Yeah, so basically, if you're a non-portfolio landlord, so what I mean by that is,
I was going to say
is 3 mortgaged buy-to-lets, no more.
Okay.
So if you have 3 mortgage buy-to-lets or less, then actually they ask a hell of a lot less questions. Your stress rates aren't as high, so you don't need a higher rent as if you're a portfolio landlord. And if you're on a lower income bracket, they prefer that as well due to the tax changes.
But so what you're saying is, if someone's experience has got 30 or 40, it's more difficult to get them finance now than it is if you've got 1 or 2.
Yes.
That's nothing to do with age or anything.
No, it's
Nothing to do with the gearing, i.e., how much deposits you've got in it.
it's all to do with these new tax changes. It's all to
That doesn't
do.
make sense to me.
Well, the thing is, the way you've got to work it out is what used to happen was, let's say you had 30 properties, let's say you had a gross rent of 100,000. Really, when you put that through the books after expenses, you're only being taxed on about 20,000. Now, because of all these tax changes and the fact that you can't offset your mortgage payments as an expense, it means that you're taxed on, let's say, 80,000.
You can't offset any of your mortgage payments or part of it.
You can offset so these are changes that are being phased in.
That's the way I understood it. It's over a 5-year period, is that right?
Yes, so they're going to be fully implemented in 2020. And if in 2020, basically you have mortgage interest only payments, you're a higher rate taxpayer, you can't offset that as an expense. What actually happens is you declare your rent, you pay your tax bill, and then they give you a 20% tax credit of your mortgage interest, and they pay that back to you.
So that's a major change, isn't it?
It's a massive change. And
We've definitely seen more buy-to-lets coming to the market, off the back of that. So I think
people selling.
Yeah, we've seen a lot of landlords of, they're now realising this, and we've seen a few more come back to the market.
What are they going to do though?
Well, I think the government just don't want amateur landlords or accidental landlords. And when you look at it, if you're going into buy-to-let, whether it's 1 property or 10, it is all about the advice that you take, because you need advice about the mortgage, you need advice about the property, you need advice about the taxation, and more importantly now, it's not about let's just buy another property and get rental income. You do need to really think about what you're going to do.
So you're saying it's got to be properly planned.
Yeah,
I mean, you used to just sort of say, well, look, I'll invest in that, I'll take my money, and it's okay.
Yeah.
That's not the way forward, is it?
What you saw, over the last couple of years, you've got lots of people taking their pension pots early and buying buy-to-let properties. But of course, what's happened now is the taxation laws have changed so much, and the regulation around buy-to-lets means that it's very difficult to actually get any real, I suppose, rental yield from it if you've just got 1 property. Yes, you will probably get capital growth if property prices continue to grow, but having 1 buy-to-let realistically doesn't give you any additional income if you're not careful.
Yeah. Gentlemen, really enjoying your company, and it's fascinating chatting to you, but we've got to hold it there and take a short break. We'll be back in a little while, and then we've got some other very interesting and I'm sure debatable topics that we want to pick up on.
Thomas Oliver, a representative of Openwork, prides itself on high-caliber quality service, with our senior advisor Vishal Gurujani at the forefront. Whether you're seeking advice on a mortgage, life insurance or a pension, we have the solutions for you. At Thomas Oliver, our financial advisors have a collective experience of over 100 years in the industry. We go above and beyond, trying to meet our clients' requirements in achieving their desired outcome in a friendly and efficient manner. Thomas Oliver is shortlisted for this year's Estas Awards as a mortgage advisor. Thomas Oliver with branch offices across North London, East London, Hertfordshire and Essex. For further information, please call 01707 872 000 or visit thomasoliveruk.co.uk. Thomas Oliver, outstanding financial services, regulated by the Financial Conduct Authority. You are listening to The Property Show, produced by Iro Levanu and presented by Karl Knipe. partner at the Kings Group Estate Agency.
I'd like to welcome you back after that short break. This is Karl Knipe from London Greek Radio. We're having a great conversation on the programme today, which is the property market. I've got Chris Bram here. We're from Metropolis Surveyors, Royden Weeks, who's the sales director for Kings Group, and Vishal Gurajani. Is that correct? Have I pronounced that properly?
It's Vishal Gurajani, but we'll give you credit for that.
That's pretty close. Pretty close. From Thomas Oliver. Yeah. Great to have you guys back. Got a few topics that we still want to move on to that I think we need to talk about, and I think the first thing I was going to say is that let's talk about Brexit. I know we briefly discussed this in the first part of the show, but I mean, how do we see this affecting the property market sort of 1, 2, 3 years? Is this going to be an issue and a problem for how long? Is it a problem?
I think it's going to be an issue for a long time.
You do, Roy?
Yeah, I think that if you give people excuses, and I don't mean that in a detrimental way, but if you give them a reason, if something big happening, then they'll use that to not make a move. They'll use that for uncertainty. So I think even after we finally managed to work out how we're going to get out of Brexit, I think there's going to be complications for years to come.
You think that's affecting the market now? Then
it's affecting the market since it happened. I think once it happened, I for one was a bit surprised. I thought probably that we'd stay in.
Yeah.
We came out, so obviously you just have to adjust. The very next day, we instantly saw sales fall apart. Where European buyers, even international buyers were like, well, you know what, it's not going to be beneficial for me to market.
Isn't that a good thing, though, that we're losing those people from abroad who are coming and taking all our jobs and taking all our houses? Surely that's great. That's keeping property prices a sensible figure. No,
I don't agree with that, because I think
you don't agree with that as an estate agent, or you don't agree with that as a homeowner?
Generally, it's both. I think, first of all, estate agency is my career, so I always look at it from that point of view. But I think that the thought process, in my opinion, from a lot of people, was probably wrong. I also think that if you look at where people are thinking, people, Europeans, nationals will be out in the market, will be able to get into the market. They neglected to understand that sellers still want top prices for their properties. So it wasn't like the sellers suddenly went, okay, well, great, we've lost loads of international buyers, we'll drop our prices for the English or the people living here. They said, okay, well, I could get 300 grand beforehand, now I want 315 grand from a property. So I don't think it's helped out in any way, shape or form. It's given us less buyers and a marketplace that is more of a struggle than I think it probably needs to be.
Chris, are you pleased to be out? Don't answer that.
No,
I just thought I'd ask.
Well, I think Royden, I agree entirely with Royden that it was a shock. I don't think anybody expected it to be a leave vote. All the polls that you looked at, but the fact is, it's done. What any property market, whichever it is, whether it's in recession or not, it relies on stability, and it does not do well on uncertainty. But I think there's a wider issue, and it's quite interesting. I was at a conference the back end of January, and one of the speakers was a guy there from Barratt's, and Barratt's are charged with building lots of new properties. They've got all these fantastic technology and new build technology that brings in different types of construction. But one of the really worrying things is that Barratt's say 95% of their labour force is Eastern European, and what we are seeing is that there's this uncertainty may mean that some of the Eastern Europeans will go back. Now,
don't you think so? Quite a few have already gone back. So that's what we read in the papers.
This is what
if
we're
you
seeing.
read the Mail every day.
Yeah, and if you
fantastic, we've sent them all back.
But the argument, of course, is that we as a nation don't want to do some of the jobs that they do. So if you look at things,
you believe
not the prices that.
I do, and I think it was an interesting.
Well, maybe we were paying them too cheaply to start with. I mean, that's the argument that Jeremy Corbyn and the Labour Party would make.
If you look at the fact that we already know there's a massive demand for property, in terms of we need to build 200,000 houses a year. If Barratt, who are one of the biggest constructors in the UK, are saying 95% of their labour force is Eastern European, and the threat is that they could lose that labour force, how on earth are they going to build the properties?
Well, if they pay people more money and don't take so much profit out of the actual sales of the property, then perhaps they'll keep those people here in the first place.
That's the old argument, isn't it? I mean, their model is built on the fact that for years they've used Eastern European labour.
They've used cheap labour, that's what you're saying, and they've made profits out of it.
So cheap labour is quite harsh to say, because the hourly rates and daily rates that are being paid were decent money. It's just, I think, sometimes, and again, it's my opinion, I think that sometimes the British worker expects to get more for doing the same job because.
And there was a recent news article that there was 2 girls, students, both British students, went to work on a vegetable picking farm down in Kent somewhere, and they lasted a day. And the reason was, they said, we can't do this job, it's too much like hard work. And I think that's what we've got to get into mind, that whether they pay them the right money or not, they just don't like doing the jobs. And that's the real problem, because if we start to lose labour, we won't build the properties that we need.
I don't know. As I say, if you listen to what Labour and Corbyn saying, they're saying the real problem is we're not paying people enough money to do the jobs in the first place. And I don't know, Vijay, what's your thoughts on that?
I think we're seeing the effects of Brexit already. I definitely agree with that. What's happened is...
how long are they going to go on for? And what's the next stage?
Well, the problem is how long it takes to change God knows how many legislations they've got to change. Changing the legislation is not done overnight, and they've got to change over 300. And I don't see this coming fully into effect for at least 5 to 10 years, just because of the time to change over legislation.
Before they even do, they set up new agreements with countries for trade and produce going back and forwards.
This is going to take a lot of time.
But in the meantime, we've got people who want to buy and sell properties, need to move for various reasons, be it to need to get closer to the school for their children, be it that they are fed up having a 28-year-old teenager in their house. They want to get them on that property ladder themselves. So maybe, as we discussed earlier, maybe they're looking at equity release to help them. Where does this leave the market? Listening to you guys, it sounds like the market's in this sort of abeyance, and it's going to be like this for a long, long time.
I think the problem is that we do like a bit of bad news, and we do like to talk the market down. And quite interestingly, when you look at the news, there is the old saying that if it bleeds, it leads, and good news doesn't really sell newspapers. But I think the important thing is we could talk the market down, but if you start to look around you, there's lots of good news around. And when you talk about things like first-time buyers, for argument's sake, we've gone through the doldrums of not getting 95% mortgages, but now we're starting to see some of the major lenders coming back. And you know this, Vishal. Only in the last week you've seen, I think, is it HSBC and Tesco have launched 95% products. Yes, there is a problem in getting deposits, but last year the 9th biggest lender in the UK was the Bank of Mum and Dad. So there is a way for first-time buyers to get in. But we've got to be very mindful that uncertainty does cause problems in the housing market. But we've got to be also careful that we just don't talk ourselves into a depression.
Both you and Vishal both said 2 things, and which is correct, and I have a huge issue with looking at it from my angle. The Bank of Mum and Dad, a lot of people I know, and even if I look at my own sort of background, don't have parents to rely on for funding. So to me, I'm looking at how do those people get onto the marketplace. If I want to buy a house and I've got a child and I've got a partner now and I need a 2-bedroom property, and say I'm just on the outskirts of London, I'm looking at anything from £200,000 to £400,000. The earning potential that I've got to have as a parent is probably more than the wages pay in this this day and age. Plus, I probably need to to have somewhere £50,000 deposit. How am I going to save up for that? What is the government's actual plan at getting those people?
Well, I think the problem is the government don't really have a plan. It comes back to Carl's original point that people aren't getting paid enough. And if you look at the pay rises that were announced for national health staff last week, over a period of the time that they're talking about introducing it actually makes very little difference. But the point is, you're entirely right, Royden, that the wage gap now for getting mortgages is massive.
That's impossible.
Lenders would go to 4 times income maximum, but in reality, you need 8, 9 times,
Yeah,
10
exactly.
times your income to get the mortgages. And
to be inside the M25 in London, as we
absolutely,
call
yeah.
it, or
Yeah.
so what? I think we were discussing it earlier. Then, so what you're saying is people should maybe look to move out, better road and rail.
How
links.
far out do you have to move out? If I work in London and I earn £30,000 a year, to buy an actual bit of blighty, I've probably got to move to Reading. So I'm going to.
I was thinking HS2. You can move to Sheffield. Chris will find you a place there. Within 2 hours, you'll be in the smoke.
Commute to work, 2 hour commute home.
Well, to be quite honest, Roy, I drive 40 miles around the M25 and that takes 2 hours some days. So sat on the train for 2 hours. But it is the cost of the train and the commuting as well.
I know there is people that do that, but I'd think to myself, I could go and have a lovely house somewhere, but I'd have to move away from my family to have it. So we essentially would be isolated in a new town with new people just to afford to.
Hey, when I was 19, I moved from Sheffield down here and lived in a bed sit.
But if I lived in Sheffield, I'd have moved out there. Right?
That's terrible, Dan. That's absolutely terrible.
That's my opinion, obviously. Sheffield, I'm sure. A great couple of football teams, at least.
Well, guys, we could dwell on that subject, and literally we could have, never mind one program, we have 5 or 6 programs having an argument about all those sort of issues. Guys, time is running out. It's been great being with you. Got one last question that I'd like you to quickly answer in one sentence. By the end of this year, is the property market going to be up? And if so, what sort of percentage? Chris, come on.
Up 4%.
Up 2%.
Vijay,
Don't think it's going to change.
well, it's going to be flat.
Yeah.
Okay, well, we shall see, shan't we? Hopefully we'll be back at the end of the year, maybe. I'd like to thank you, Chris. Thank you very much. Chris Crammon, Metropolis, lovely having you here. Royden Weeks, some great answers there from King's Group. Thank you. And Vijay, absolutely superb. You gave us a real good insight into the finance side of the world, and perhaps maybe 1 or 2 of you guys can come back in one of the other shows that we've got. I'd like to thank you guys, the audience, as well, for listening with us today. Without you, that we wouldn't have the show, but hopefully you've enjoyed all the topics and things we've talked about. We'll be back. It will be the first Wednesday of May, same sort of time, 7:15. We shall look forward to having another discussion to you. If in the meantime there's any questions that the show's brought up, please can you email IRO, that's IRO at lgr.co.uk. Some of your questions, IRO will pass those on to me, and maybe in the next show we can address some of those. Thank you very much for listening today. Hopefully you've enjoyed it. Hopefully it's been interesting. We'll see you again soon.
The Property Show was brought to you by Thomas Oliver. Outstanding financial services. No confusions, just solutions.
Thomas Oliver, a representative of Openwork, prides itself on high caliber quality service, with our senior advisor Vishal Gurajani at the forefront. Whether you're seeking advice on a mortgage, life insurance or a pension, we have the solutions for you. At Thomas Oliver, our financial advisors have a collective experience of over 100 years in the industry. We go above and beyond, trying to meet our clients' requirements in achieving their desired outcome in a friendly and efficient manner. Thomas Oliver is shortlisted for this year's Estas Awards as a mortgage advisor. Thomas Oliver with branch offices across North London, East London, Hertfordshire and Essex. For further information, please call 01707 872 000 or visit thomasoliveruk.co.uk. Thomas Oliver, outstanding financial services, regulated by the Financial Conduct Authority.